Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Saturday everybody. The big news from the last 24 hours is that Chinese stock market saw frenzied trading again on yesterday, after remarks at an investor conference by a former chief epidemiologist at China's CDC that relaxation of COVID-19 controls will begin soon for China and reopening will occur gradually before spring 2023, which, if accurate, would be a huge deal and would certainly help stabilize the economy going forward into next year. Yesterday, we explored just how disruptive zero COVID has been for the Chinese economy. We also learned that the State Council Joint Mechanism on COVID Prevention announced that it will hold a press conference on Saturday. As of the filming of this video, no press conference has been held. If there is a major announcement, like confirmation of the end of zero COVID, then we will likely have a special video on Sunday, tomorrow. The markets, though, are already going crazy over the possible news. After nearly 2 years of decline and $6 trillion of losses, Chinese stocks soared at the fastest pace worldwide this week on this frenzied speculation, driving the Hang Seng China Enterprises Index to its best weekly gain since 2015, surging as much as 8.8% on Friday, with technology companies leading the charge. Internet giants Alibaba Group Holdings Limited and Tencent Holdings Limited soared at least 7% each at the close of trading. The Hong Kong's Hang Seng Index rebounded almost 9% this week, its best gains since 2011. The CSI 300 Index, the benchmark for mainland stocks, also jumped more than 3% on Friday. The Nasdaq Golden Dragon China Index, a modified market capitalization weighted index comprised of companies whose common stock is publicly traded in the United States and the majority of whose business is conducted within China, surged almost 9% during US trading on Friday and up almost 20% this week, though from a very low base. Indeed, all of these jumps that we are seeing here are from very low bases. The shares of PRC firms with US listings also saw surging this week, in part because US media is reporting that US audit officials have completed their first on-site inspections of Chinese companies ahead of schedule. Like I said on Tuesday, after the first jump in Monday trading, investors pouring back into the market could be on the money if an exit strategy for zero COVID is indeed about to be announced. Quote, "It seems markets are very much chomping on any bits of positive news, whether big or small, as a potential catalyst for Chinese shares, based on the valuations and that a lot of the bad news has been baked into those shares. Investor sentiment is more geared towards the upside than the downside." End quote. Of course, if Beijing doubles down on zero COVID, expect another collapse in markets similar to what we saw after the 20th Party Congress. And it's important to stress that nothing has been confirmed officially yet. At this point, the market is just jumping at rumours. Quote, "With so many positive chatters in the market, the indexes are having a relief rally. There are so many rumours. Nothing is confirmed, but people are buying on those tips." End quote. Okay, now let's move from the short-term financial movements to more medium-term economic developments. And first up for the Chinese economy, according to London-based research firm Prechen, venture capital investments in China are falling sharply this year, making it one of the worst-performing countries globally. The firm cited a regulatory crackdown and decline in technology valuations as the leading reasons for the downturn. The value of venture capital deals in the country tumbled 44% to $62 billion through October year on year. Bloomberg analysts write that, quote, "China once rivaled the US for capital invested in startups before President Xi Jinping's administration embarked on sweeping efforts to overhaul the practices of giants like Alibaba Group Holdings Limited and Tencent Holdings Limited." End quote. And of course there is also the question of rising capital costs. The report does provide one piece of positive news. The semiconductor sector has done well, seeing a 24% increase compared with the same period last year. Though it will be interesting to see how the latest round of tough US restrictions against Chinese chip ambitions will impact this part of China's venture landscape going forward. Next up, General Secretary Xi Jinping, speaking at the opening ceremony of the 5th Annual China International Import Expo, currently being held in Shanghai, said Beijing will, quote, remain committed to its opening up policy and help other countries share in opportunities in its domestic market, end quote. She continued by expressing that China will pursue a, quote, mutually beneficial strategy of opening up and adhere to the course of economic globalization, end quote. She also reconfirmed that China will actively seek to join the so-called Comprehensive and Progressive Agreement for Trans-Pacific Partnership, the latest incarnation of the controversial TPP, which former US President Donald Trump pulled out of during his first week in office. Okay, we have one last important update to cover for today. If you're enjoying today's episode, don't forget to hit that like button. And as always, anyone who can go that extra mile and help me continue making these episodes every day, help me keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much, everybody, for the ongoing support. Yes, and finally, it would not be China Update without an observation from Peking University Professor of Finance, Michael Pettis. Yesterday, Professor Pettis responded to comments made by Mr. Guo Shuqing. Mr. Guo, chairman of the China Banking and Insurance Regulatory Commission, speaking at an event this week, warned that the massive financial resources of high-tech sectors like the internet and big data, quote, put them at greater risk of becoming over-leveraged, and this must be prevented, end quote. Pettis largely agrees with the comments, but points out a potential policy conflict for Chinese leadership, expressing, quote, one way Beijing hopes to manage a much-needed reduction in property and infrastructure spending without a sharp corresponding drop in growth is to redirect resources from those sectors into more productive sectors of the economy. The prime candidates, of course, are the high-tech sectors, but as I've long pointed out, property and infrastructure comprise at least 4 to 5 times the share of GDP as does high-tech, and the latter is already flooded with capital and resources. This suggests that shifting even a part of property and infrastructure spending into the high-tech sectors might just create new forms of excess and lead to new kinds of financial fragility. It seems that Guo is, perhaps a little less directly, making the same point, end quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. If there is not a special episode tomorrow on Sunday, then I will see you all again on Monday. We are still currently waiting for that announcement from the State Council. If the body unpacks or announces some concrete plan with a timeline for China to exit zero COVID, then we will probably need to discuss it on Sunday. Wherever you are, I hope you're enjoying your weekend, and I will either see you tomorrow or on Monday.